Advantages and disadvantages of public limited companies. The first advantage here is this form of business organization still offers limited liability to shareholders. So shareholders are not going to lose their personal wealth or property or assets in case of bankruptcy. They're not going to lose it. But the only thing they're going to lose is their investment into the business. Clear?
Yes.
2, it is an incorporated business and has a separate legal identity to the owners or shareholders. Its accounts are kept separately from those of the owners, and there is continuity should one of the shareholder dies. So here, another advantage for a public limited company is that it has a separate legal entity, which means the account of the business is run separately from the account of the owners of the business. As a result, whatever happens to any of the shareholders or the owners of the business will continue to run because it is not unlimited liability.
It has its own personal
liability. Yeah, clear. The third advantage, there's now the opportunity to raise very large capital sums to invest in the business. There's no limit to the number of shareholders a public limited company can have. So because you don't have a limit, you don't have a maximum of numbers that you could have as shareholders. So it means you have unlimited capital injection into the business, which is an advantage. The next one, there's no restriction on the buying, selling, or transfer of shares. Unlike the private sector. In the private sector, all shareholders in the private sector must agree that these shares has been transferred to a certain individual.
So they can sell it or buy it,
yeah. So, but for public limited company, even the company does not have authority over who you sell your shares to. Though there's always what we call share redemption, where you have to buy back your shares. But that's in accounting, A-level accounting. We call it share redemption. So there, if it's going to happen, it would have meant that the company itself have had agreement with those that bought the shares, that at a certain period of time, we're going to buy back our shares. We call it share redemption.
Yes.
So this also happens if the company has enough in its reserve. That's accounting them.
In the general reserve? Right?
Yes, in general reserve. Clear?
Yes.
All right, so that's about transfer. Then the last one here, it said, a business trading as a public limited company usually has high status and should find it easier to attract suppliers prepared to sell goods on credit and banks willing to lend to it other than other types of business. As a public limited company, you are big, you are huge, you've got a reputation. So you are credit worthy. That is the point, that you are credit worthy. As a result of that, suppliers will want to sell with you. Suppliers want to associate with you. They want to link up with you because they know their money is secured and safe with you. Banks want to lend you money. They want to do business with you because they know that you always pay back. You are not a high risk. Is it clear?
Yes.
So
that means that public limited company is like the advance of a private limited company.
It's an expansion of,
So every public limited company has they don't have that risk.
No, all businesses have risk. All business. Let's look at the disadvantages now.
Yeah.
All right, the first disadvantage. I told you, the first thing is this. As you become a public limited company, you start losing the ownership. Because you are selling shares to people. As soon as you are selling shares, the number of shares you held reduces.
Yes.
So now let's go to the disadvantages now. The first one. The legal formalities of forming such a company are quite complicated and time-consuming. You have to prepare your article of association, memorandum of association, and it has to go through the registrar of companies. This takes time.
Yes.
2, there are many more regulations and controls over public limited companies in order to try to protect the interests of the shareholders. This includes the publications of accounts which anyone can ask to see. So there are always, checks and balances in the public limited companies because they have to, government institutions, they have to protect the interests of the shareholders because they are investing in a company that they are not going to be the one to run it. Do you understand? So their money must not be lost. As a result, it's so complicated to the extent that you have to publish your profit or your loss. Everybody has to see it because they have purchased, they have invested into the business. So they have to see how the business, they have to see the performance of the business. They will question that. Is it clear? And in the course of you providing or publishing your company's performance, your competitors will see. They'll be able to weigh or measure your performance with regards to theirs.
Yes.
The next one. Selling shares to the public is expensive. The directors will often ask a specialist merchant bank to help them in this process. It will charge a commission for its services. The publication and printing of thousands of copies of prospectus is an additional cost. You have to prepare a prospectus, which is just like a form, letting them to understand the benefit of buying shares with you. So that's what they're going to see first. You have to issue a prospectus, telling them what the prospect of investing in your company's shares are. That will convince them to buy. So you have to print a lot of papers. These are expensive.
Yes.
Do you understand?
Yeah.
And you have to pay the banks that are going to sell. You are not going to be the one to sell your shares. It will be bought from the banks. Banks are the ones that sell shares.
Yeah.
It's your shares,
Okay.
but it will be sold through a third party, which is the bank.
Okay.
People will not come to your company. How big is your company? You want them to come and queue and start paying you? No. It goes through your bank account. Clear?
Yes. So.
Okay, but you pay banks for that, for the service.
Okay. Good.
There is a very real danger that although the original owners of the business might become rich by selling shares in their business, they may lose control over it when it goes public. This is an important point which we will investigate further. So the next disadvantage is that as soon as you sell shares, more money comes. Control is losing. You lose control. It's an opportunity cost. You can't. There's no other choice. It's a trade-off. Sorry, I would prefer to use a trade-off.
Trade-off.
Yeah, which means money comes, ownership is lost. Ownership lost. It's a trade-off. Clear?
Okay. Yeah.